So you're not a federal regulator, you're a state
not.
regulator, but you're very much involved in all of this.
Yes.
How do you feel about things like what the Fed is proposing right now, like what is being proposed in Congress in trimming back on Dodd-Frank?
So look, I mean, the devil is in the details, and they did make this proposal yesterday, but I think it's important to think about what does leverage ratio mean, which is really what they're proposing to change, and the freeing up of capital. What does that mean? You know, banks hold the deposits of ordinary people as well as people with greater wealth. And the FDIC insures those deposits, and the banks use those deposits to lend. And if you start freeing up this capital, what you're really doing is you're allowing the banks to use depositors' money to engage in other activities, and that's a risk, and that's a risk to our entire banking system. It's the risk to the ordinary people whose deposits are there, and that's why the FDIC is not one of the federal agencies that is part of this proposal, and I think that's very interesting to think about.
Exactly right. The report, at least in the Bloomberg, was that the FDIC is none too happy about this. They don't like it.
Not surprising.
Although, in fairness, the FDIC is continued to be run by an Obama appointee.
Well, that may be, but politics aside, the FDIC is an insurer, right? They insure those deposits, and they're on the hook if there is an economic crisis or even just in one of those banks. And I think we have to remember that the financial crisis was just 10 years ago, and we should not fail to continue to remember the lessons of those crises. Now, the banks are doing very well. Their profits are up. They have a sufficient amount of capital, most of them, but there are many, many ordinary people and homeowners that are still suffering from the crisis. So I think we have to always keep that in perspective.
So Maria, you really have your finger on the pulse of the banking segment in New York, as well as the regulatory status.
Try to.
Where are we? Let's talk specifically about the Crapo Bill. That is the bill pending in Congress that a lot of people think will make it through, that will cut back some on Dodd-Frank, particularly as it applies to some of the smaller banks. Not so much the big ones, but the smaller ones.
Right.
Do you think that that's a sensible approach?
Well, certainly I am very much in favor of any support that we can give to our community banks. So in our dual banking system, mostly the state regulators, I mean, I have some very large institutions because I'm in New York, but most of the state regulators, really what we focus on is our community banks because they are on the ground in our communities providing, you know, services, access to capital for our communities, our small businesses. And so any effort, and there are certainly efforts in the Crapo Bill, which is a bipartisan bill, and there are efforts in there to help community banks. However, the phrase, "this is about community banks," is really hiding that there are elements of that bill that help the very big banks, such as the increase in the threshold from $50 billion to $250 billion in assets in terms of the greater regulation. And I think we should be concerned about those things because there are a lot of very large banks that will then not be subject to some of the greater DoddFrank oversight, and I have some concerns about that.
So you think going from the 50 to 250 is too big a step?
I think it's a significant step, and I think the stress tests and the additional oversight by the Federal Reserve that Dodd-Frank provided is something very important to ensure fiscal stability and the protection of consumers.
What is the connection, if any, between this sort of regulatory reform and the possibility of more consolidation, particularly among the smaller banks? If in fact we change the regulations, will it free up a lot of these banks to consolidate? And is that a good thing?
Well, it depends on the circumstance, but I think what we're seeing, there's a problem because some of these large banks, when you're freeing up the liquidity, you have the large banks taking over, and it hurts our community banks. And I think our community banks are the ones that are in the communities doing the work, and a lot of these large federal banks are not generally liked by the public. They're not necessarily in the communities doing the work of the public. And I think we have to be very, very careful of further consolidation. Already our banking system is overrun by that. And then you add to that some of these other disruptors who are the marketplace lenders that are trying to get in the market, also further hurting our community banks and the payday lenders and everything else. And there's a lot going on federally on that as well.
Well, what about at the state level? I mean, how can you deal with that issue? Because there is this issue of the so-called non-bank banks going into banking. And even if we're regulating the banks perfectly, we're missing increasing numbers of people who are coming into that space.
That is true, but we shouldn't be missing them. And in New York, you know, we have usury rates, we have certain requirements, and if you're lending, you are subject to the same laws. And the same thing should be on the federal level. And I don't think we should give any special treatment to people that are engaged in bank-like activities to not be regulated like banks are. There should be a fair playing field, and there should be consumer protection regulation overall.
So briefly, whether it's federal statutes such as DoddFrank or whether it's regulations, how much of a say do you have? Do you get to go in and give comments? Do you have your views expressed in the federal government? Do they listen?
Well, I certainly have my views expressed. I've had many meetings, on the federal level. The state bank commissioners, we have gathered together and had had many discussions on the federal level. And there are certainly places where we have our unique role, and there are many, many places where we can fill the gaps with this deregulatory environment. Why? To protect the markets, because some of this is just giving too much access back that could actually raise some real risk to the economy.